Hello, welcome to Chapter 11. Today we're going to talk about depreciation of non-current assets. Learning objectives. So by the end of this topic, you should be able to identify the characteristic of a depreciable non-current asset. Okay, you need to be able to define a couple of terms: depreciation expense, depreciable value, carrying value, residual value, and useful life. You need to explain what's the purpose of depreciation, okay, why we need to depreciate a non-current asset, and its relationship to accounting principles and qualitative characteristics. You need to know how to calculate depreciation expense using the straight line method. Okay, we're going to learn about straight line method in Unit 3, and we're going to look at an alternative depreciation method in Unit 4. You need to know how to record depreciation in the general journal and the general ledger. You need to know how to report for depreciation in accounting reports in both the income statement and the balance sheet. You need to explain what's the effect of depreciation on accounting equation, and finally define the term cost as it refers to non-current assets. Okay, depreciable assets, what is it? A depreciable asset is a non-current asset that has a finite life. Okay, so basically the finite life refers to a limited period of time for which a non-current asset will exist. Can you think of any examples of depreciable assets? Well, non-current assets such as shop fittings, office equipment, vehicles, or business premises, they are all considered as depreciable assets. Okay, they are non-current assets because they provide a future economic benefit for more than 12 months to the business. They are also depreciable because they wear out. As they age, their productive capacity will be reduced. So in effect, depreciable assets, they are consumed over time, and each year, part of the value of the asset once consumed, we consider that part as the depreciation expense. Okay? Alright, and the process of calculating how much value has been consumed in each period is called depreciation. Alright, you need to note that there are assets, okay? The exception when assets have infinite life, for example, land, okay? Assets such as land, they will not be depreciated, okay, because the economic benefit will continue forever. They have infinite life and they never can be used up. Depreciation, as we mentioned before, you need to think about depreciation as an accounting procedure. The definition is it is the allocation of the cost of a non-current asset over its useful life. Okay, since a non-current asset is not going to be used fully or consumed fully within one reporting period, depreciation is necessary to calculate how much of the asset's value has been consumed in the current reporting period. Alright, now think back to balance day adjustment. We talked about balance day adjustment in the previous chapter, chapter 10. The purpose of depreciation is the same as the purpose of any other balance day adjustments. Okay, depreciation is just another type of balance day adjustment. Okay, we had to make balance day adjustments because we need to basically ensure that accurate profit is calculated by matching revenues earned and expenses incurred in the current reporting period. And this is exactly the purpose for depreciation as well. Okay, so linking to the reporting period principle, you need to make sure that the revenues earned in the current reporting period is matched to the expenses incurred in the current reporting period. So if in this reporting period you have used a non-current asset to generate or to earn your profit, then we need to take into account the part of depreciation expense that has been consumed in the current reporting period. Okay, another purpose of depreciation is also to ensure that income statement actually includes all relevant information that is useful for decision making. Okay, and this is related to the qualitative characteristic of relevance. All right. So as a result of the depreciation process, the depreciation expense is created. And the definition for depreciation expense is it represents that part of the cost of a non-current asset that has been consumed in the current reporting period. All right. So depreciation expense is another example of a non-cash expense. Can you think of any other examples of non-cash expense that we have learned already? Okay. If you're thinking along the lines of bad debt expense or discount expense, then you're correct. Okay. Depreciation expense, it's a non-cash expense because it doesn't involve any payment of cash. And therefore, depreciation will have no impact on cash flow statement. Okay, we're going to look at cash flow statement in the next topic, chapter 12. Depreciation expense, for the moment, you just need to note that it only affects income statement and balance sheet. Okay. Now, calculating depreciation expense. How do we calculate the depreciation expense? We can calculate it through what we call the straight line method. Okay. There are several different ways to calculate depreciation expense. Each has its own set of assumptions about the way that assets are consumed or used up. In Unit 3, we will only look at, the study design only requires us to look at the straight line method of depreciation. Okay. In Unit 4, we will also examine an alternative method of depreciation. It's called the reducing balance method. Okay, but that's Unit 4. All right. Okay, so let's have a look at the graph here on the right. Okay, now this is a graphical representation of straight line depreciation. Let's imagine that you've got a non-current asset. Okay, for example, a delivery van. Okay, its initial cost is going to be the initial value of the van is going to be 10,000. Okay, and eventually, as it wears out, as time goes on, as the years pass by, okay, the value of the van is going to be depreciated over time. Okay, so it's going to reduce gradually over time. All right. Now, a key assumption of the straight line method is that the productive capacity of the non-current asset contributes evenly to revenue. And what that means is that it assumes that the value of the non-current asset is consumed evenly over its life. In other words, the depreciation expense for the non-current asset is going to be constant across time. Let's say each year, if the depreciation expense on the delivery van is going to be 2,000, okay, each year, that's going to remain constant. Okay, depreciation expense is constant each year. And when you draw that, plot that on the graph, it's going to be a straight line, and therefore the name straight line method of depreciation. All right, let's have a look at the formula for calculating depreciation expense. Depreciation expense, the dollar amount per annum, is going to be calculated by we use historical cost, HC, abbreviation minus RV, the residual value, divided by life, its useful life. Okay, let's have a closer look at each of the elements here. Historical cost. Okay, historical cost just means the original purchase price of the non-current asset. Okay. Residual value. What is residual value? Well, residual value is an estimate. It's the estimated value of the non-current asset at the end of its useful life. Okay, that's basically how much the asset is worth at the end of its useful life. And useful life is the estimated period of time for which the non-current asset will be used by the current entity to earn revenue. It's usually measured in years. All right. And another definition I want you to take notice of is depreciable value. Depreciable value is calculated as the difference between historical cost and residual value. Okay, that is the total amount in terms of dollar value that asset is going to be depreciated over time. All right. Let's have a look at an example. Okay, an example from your textbook. So on 1st January 2015, Big Cycles purchased office furniture for $5,000 plus 500 GST. The furniture will be kept for 3 years, at which time it will have an estimated residual value of $800. If we want to work out the depreciation expense, we just apply the formula. Okay, use the historical cost in this case is 5,000 minus the residual value. Okay, that's how much the furniture is going to worth at the end of its useful life, $800 in this case, divided by 3 years. Okay, that's its useful life, 3 years. Okay, and you get $1,400 per annum, the depreciation expense per year. All right, so again, just a quick recap. The asset was purchased for $5,000. Big Cycles plans to dispose the asset after 3 years. Okay, after 3 years, at which time the residual value of the asset is worth $800. All right, this amount is going to be consumed by the next owner if you decide to sell the furniture at the end of the 3 years to someone else. Okay, so in essence, 4,200 will be consumed by Big Cycles. All right, so question for you. What is the depreciable value? Given we've talked about the definition of depreciable value, what is it? Okay, in this case, it's going to be 4,200. And how much depreciation expense is reported in the income statement each year? Okay, each year, what's the depreciation expense? We've just worked that out. Okay, $1,400 per annum. All right, recording depreciation. Now, okay, as we mentioned earlier, depreciation is a balance day adjustment. Okay, hence at the end of the reporting period, an adjustment is required for depreciation in the general journal. Again, let's have a look at an example. On the 1st of January 2015, Mixwell Paints purchased a new van for $32,000 plus 3,200 GST. Depreciation on the van has been calculated at $1,200 per year. Memo 5. Okay, at balance date, that's at the end of the reporting period, 31st December 2015, the balance day adjustment for depreciation would be recorded in the general journal as follows. Okay, so in the general journal, we would debit depreciation of van. So depreciation of van, this is the expense account. Okay, so we debit expense account, debit-nated account, we debit this account, 1,200 per annum depreciation. We need to credit accumulated depreciation of van. This is what we know, what we call as a negative asset account. Okay, and we'll talk about this more later on. Okay, so basically, it's an accumulation account of how much depreciation there is to date. Okay, you need to credit accumulated depreciation of van. And the narration would be yearly depreciation on van using the straight line method, Memo 5. Okay, note the general journal entries are very, very specific. So the titles are, the accounts are titled Depreciation of Van, and accumulated depreciation of van rather than just depreciation and accumulated depreciation. This is so because most businesses will depreciate more than one non-current asset. Okay, businesses will have more than one non-current asset, so it's important to specify, to identify which non-current asset is being depreciated. All right, so posting the journal entry to the general ledger, what would we have? We will have an expense account, okay, depreciation of van, this expense account, because it's an expense account, you debit, okay, so you debit and cross-reference the other account that's being affected is accumulated depreciation of van. So you debit the depreciation expense for the year 1,200. For the accumulated depreciation of van account, the negative asset account, you need to credit, because asset accounts are debit-nature accounts because it's negative asset account, so you need to credit this account. Okay, so credit and the cross-reference is going to be depreciation of van, 1,200. Okay, let's have a think about what's the effect of this journal entry on the accounting equation. Okay, so assets equals liabilities plus owner's equity. Okay, on the asset side, when you record the depreciation, you're going to decrease the asset. Why? Because you've increased the accumulated depreciation of van. You've increased this account, the negative asset account. So the overall effect is going to be a sort of negative effect on the asset account. Decreases assets by 1,200. Liabilities, no effect. On owner's equity, okay, because we've increased our depreciation of van expense, we've increased an expense account, therefore we decreases our net profit, and hence we decreases our owner's equity. Okay. Alright, just making sure that we understand depreciation and accumulated depreciation and how they're different. Let's have a look at these two. Okay. What are the main characteristics? Well, depreciation refers to the depreciation expense. It's an expense consumed in the current reporting period. Whereas accumulated depreciation refers to depreciation that has accumulated over the life of the asset. Okay, it's an accumulation account. And accumulated depreciation will grow every year as the depreciation expense for each period is added to it. Alright, depreciation as an expense, depreciation, it must be closed, okay, to the profit and loss summary account, like all expenses do. They all need to be, at the end of the reporting period, they need to be closed to the profit and loss summary account. Alright, in contrast, accumulated depreciation, it's an ongoing account. It will be balanced at the end of the period, okay, and its balance needs to be carried forward to the next reporting period. Alright, so now after the depreciation of van account has been closed and the accumulated depreciation of van account has been balanced, this is how the ledger account would appear. Okay, so in the general ledger, after you've closed off the expense account, depreciation of van expense account, you would close it off. Remember how to close off expense account? You'll need to credit, right? Credit the profit and loss summary. So we're transferring this expense, okay, across to profit and loss summary. And reset this account to 0 to get ready for the next reporting period. Now for the ledger account, accumulated depreciation of van, the negative asset account, remember that we credit this account, okay, and we need to, because it's an ongoing account, So we need to close it off. We need to balance this account. Okay, so 1,200, write the balance, 1,200. Okay, at the end of the reporting period, 31st December 2015, and then carry over the balance to the start of next reporting period. Alright, in subsequent reporting periods, we will need to continue to depreciate the van. So at the end of 2016, another 1,200 of the depreciation expense must be recorded. And you'll just need to do the same thing, okay? So how we record it, basically debit the depreciation of van, debit this expense account, yeah, 1,200, and you credit the accumulated depreciation of van. You credit this negative asset account, okay? And the narration would be yearly depreciation on van using the straight line method, memo 12. Alright, so let's have a look at the posting. Posting to the general ledger at the end of 2016 would show, okay, again you would have an entry in the expense account, depreciation of van 1,200. At the end of the reporting period, okay, close it off to the profit and loss summary account. So you credit profit and loss summary 1,200. In the accumulated depreciation of van account, in the negative asset account, now have a look at what's different here. Alright, you already have a balance of 1,200. Why would you have a balance of 1,200 at the start of the period? Because that's how much you carried over from the last reporting period, correct? Okay, and now for this reporting period during 2016, okay, you've accumulated another 1,200 in terms of depreciation expense. Okay, so record that. And now in total you have 2,400 accumulated depreciation. And you need to balance this account at the end of 2016 and carry over the balance to the start of the next period, 2017. Alright, so just a quick recap. Note the depreciation of van account had been closed and reset to 0 at the end of 2015. So the depreciation expense for 2016, this will be the only entry. Okay. However, for the accumulated depreciation of van account, it's already got a balance of 1,200 carried over from 2015. So the depreciation for the current year, okay, 2016, when this is recorded, the balance will now increase to 2,400. Okay. Once again, this account would need to be balanced and carried over to the next period, 2017. Alright, I want you to have a go at these practice exercise questions. Okay, exercise question 11.2 on textbook, your page number 256, exercise 11.3. Okay, page 256. We will talk about we'll go through the solutions for this in class. Now, reporting depreciation. Okay, depreciation, as we said before, it's a non-cash expense, so it will not have any effect on cash flow statement, but it will have an effect on the income statement. Okay, because depreciation is an expense, it's going to have an effect on the income statement for sure. It's also going to have an effect on the balance sheet. Firstly, let's have a look at the effect of depreciation on income statement. So we've already covered income statement. Okay, you all know how to prepare an income statement. Now let's have a look at this one, Mixwell Paints income statement for 2016. So you have your usual headlines, revenue, okay, sales, less cost of goods sold. Okay, remember what to include in the cost of goods sold, all the costs that are incurred or necessary to bring the goods in a position and location ready for sale. Okay, so sales minus your cost of goods sold gives you the gross profit. Okay, less stock loss gives you the figure for adjusted gross profit, and less other expenses. These are the other expenses: wages, advertising, discount expense, depreciation of van. Okay, that's where depreciation goes. It belongs to other expenses, and rent. Okay, so use the figure adjusted gross profit less other expenses, and this will give you the net profit. Okay, so because depreciation is an expense, so it should be reported in the income statement along with other expenses. Alright, what about balance sheet? Okay, so instead of giving you an entire balance sheet, now what I've done here is just to show you an extract of a balance sheet. Okay, an extract on the asset side, okay, under the heading of non-current assets, okay, because these are the assets that need to be depreciated. Now, let's have a look at under the heading of non-current assets. You have van that's worth 32,000. Okay, this is the historical cost. Okay, the initial cost, how much the van was bought for. And you have a separate line here, less accumulated depreciation. That's how much depreciation there is. Okay, how much depreciation there is to date, 2,400. And you use this figure, okay, 2,400 subtracted away from 32,000. This gives you the subtotal for the van in terms of its worth. Okay, the value of the van as at 31st December 2016. Alright. Now, as we said, the 32,000 is the historical cost. Okay, so to satisfy the qualitative characteristic of reliability, remember assets must always be reported initially at its historical cost. Okay, because this amount is verifiable by reference to a source document. This is why we need to include historical cost. 2,400 is the accumulated depreciation. Okay, this amount represents the amount of assets value that has been consumed, and this satisfies the qualitative characteristics of relevance. So the balance sheet must include information that is relevant and useful for decision making. Alright, this is why we need to sort of update this figure and provide what is the accumulated depreciation figure. Now, there's a name for the 29,600 in this case. It is what we call the carrying value. Carrying value is calculated by deducting accumulated depreciation from the historical cost. It represents the value of the asset yet to be consumed, plus any residual value. Okay, it is how much is left in the assets. And now, so what's the effect of depreciation on balance sheet? Well, there are two effects. Firstly, if it occurs on the asset side, so you can see here, okay, on the asset side, this is on the asset side, right? Accumulated depreciation reports the value of the asset that has been consumed so far. Okay, so whenever you update your depreciation figure, it's going to affect accumulated depreciation. Okay, and when you take this figure away from the historical cost, it's going to have an updated figure for the carrying value. Alright, so this is how on the asset side depreciation affects balance sheets. Okay, now on the owner's equity side, which is not shown here, but on the owner's equity side, now let's think back to depreciation expense. When we reported our income statement, depreciation expense will reduce our net profit, and this in turn will reduce our owner's equity. Okay, so on both sides of the accounting equation, okay, on the asset side of the balance sheet, when you increase your accumulated depreciation, this is going to reduce assets. Okay, on the owner's equity side, when you increase your depreciation expense, this is going to reduce net profit and hence reduce owner's equity. Okay, no effect on liabilities, no effect. All right. So on both sides of the accounting equation, the effect is going to be the same. Okay, the accounting equation still balances. Okay. Now, what this is about is basically, I just want to show you a table. Okay, if you have, let's take an example of Mixwell Paints again. We depreciate the asset, non-current asset here is the van, okay, over a couple of years, 2015, 2016, 2017, and 2018. Okay, so this top line here represents the historical cost, 32,000, which stays the same. Over the years, the accumulated depreciation, what will happen to it? It's going to increase, right? Okay. Now, the carrying value is going to decrease. Okay, so we can represent this situation, this scenario, using a graph, graphical depreciation. Now, using the straight line depreciation, what you can see here, the orange line is the carrying value. The carrying value will decrease over the years, okay? Now, on the graph here, the gray line is accumulated depreciation. That's going to increase throughout the years. And the blue line, which represents the depreciation expense, that is a fixed amount because we are using the straight line depreciation method. So the depreciation expense each year is going to remain constant. All right. So why am I giving you a graphical representation? Is because I need to remind you of the accounting qualitative characteristic of understandability. Okay, what does that say? Qualitative characteristic of understandability. Reports must be prepared in a manner that is readily understandable by the user. So using graphs where possible is a really good strategy that can be used to enhance understandability. Okay. All right, the rate of depreciation. Depreciation can also be expressed as a rate, that is, as a percentage of the cost. Now, depreciation rate formula. Depreciation rate percent per annum is calculated as depreciation expense in dollar amount divided by the historical cost times by 100. So let's have a look at an example. All right, if we have a historical cost of 5,000, residual value of 800, useful life 3 years, depreciation expense of $1,400 per year, what's going to be our depreciation rate per annum? Well, the rate is going to be calculated as depreciation expense, $1,400 in this case, divided by the historical cost, 5,000, times by 100. So that's 28% per annum. Okay. How can we interpret the 28%? 28% of the asset's costs will be consumed each year over 3 years of its useful life. Okay. Now, 28% times by 3, that's 84%. Okay, 84% is going to be consumed over 3 years. So what about the remaining 16%? The remaining 16% is the residual value. All right, so if you use 800 residual value divided by the historical cost, 5,000, that's going to give you the remaining 16%. Okay, so why do we need to know this? Because sometimes in the question, it's, instead of giving you information such as residual value, useful life, and then ask you to calculate, the depreciation expense, okay? Sometimes you'll be just given the depreciation rate and historical cost. And from there, you need to work out what's the depreciation expense. Well, you know how to do this by now. So using the rate formula, just used depreciation rate times by historical cost. That will give you the depreciation expense dollar amount per annum. Okay, let's have a look at an example. So on the 1st July 2015, okay, Carlton Clothing purchased the shop fittings for $9,000 plus 900 GST. The shop fittings are to be depreciated at 15% per annum. Balance day is 30th June 2016. Okay, so here you're given the depreciation rate. If we want to calculate depreciation expense per annum, use the depreciation rate, 15%, times by the historical cost, which is 9,000. Okay, so we've just worked out our depreciation expense per year, $1,350 per annum. All right, the cost of a non-current asset. Okay, so far we have examined assets whose cost is just simply its purchase price. Okay, so how much was the purchase price, how much was the historical cost? In reality, though, quite often there are other costs incurred to bring the asset into a location and condition ready for use. And what I mean by that is other costs, okay, can be things like, obviously the purchase price, the initial historical cost, but also other costs like delivery costs, okay, modification costs, okay, installation costs. So let's have a look at an example. So on 1st March 2015, Danny's Donuts paid 26,000 plus 2,600 GST to purchase a new oven. Okay, check number 32. The payment covered the following costs. Okay, so the historical cost, the supplier's price for the oven was $22,000. Okay, there was also an installation cost, 3,000. Okay, and you're also told that there's a maintenance fee, $1,000 per year, plus the GST, 2,600. That totals up to $28,600. So the question for you to consider is what should be included as the cost of the non-current asset. Okay, so you need to think about what costs are necessary to bring the asset into a location and condition ready for use. Firstly, obviously, supplier's price for the oven. How much the oven cost? Surely that's part of the non-current asset, right? $22,000. Installation cost. This cost, it's also necessary to bring the asset into a location and condition ready for use, 3,000. So you add that on. So the cost of oven is really $25,000. Okay, we'll talk about why maintenance fee is not included. So 25,000 is the amount to be depreciated over the useful life of the asset. Okay, the maintenance fee 1,000 is an annual cost, a yearly fee. Okay, the benefit, the key is benefit will be consumed within a year. Therefore, it's not part of the value of the non-current asset by definition. This will provide you with benefit greater than 12 months. Okay, so the 1,000 maintenance fee, okay, it's really a current asset because that's going to be consumed within a year. Okay, a current asset, and it's going to be categorized as a prepaid maintenance. Alright, let's have a look at how we can record the purchase of the oven in the cash payments journal. When we initially make the payment to purchase the oven, okay, so on the 1st of March, we record in the bank the total amount that went out. Well, 2,600 is the GST. We need to write it separate in the GST column, okay, and 2,500 we record that under the sundries column, okay. This is the cost for the oven, okay. And prepaid maintenance we write in a separate line. Prepaid maintenance is $1,000, okay. We've deliberately on purpose wrote that in a separate line because it's not considered to be part of the cost of the oven. Okay, now post this to the general ledger. In the bank, in the general ledger, now in the bank account, in the ledger, what you need to post here is just to post the totals. Okay, so you would have a balance. Okay, this is all given. You would have a balance, cash receipts for the month of March. Now cash payments, this is 75,000 taken directly from the cash payments journal. In the oven, okay, in this asset account, you need to debit because it's an asset, so we debit, okay, 25,000. This is the cost that we're attributing to the non-current asset oven. Cross-reference bank because we use cash to pay for it. Prepaid maintenance, it's also an asset account, however, it's a current asset account, okay. Prepaid maintenance 1,000, cross-reference is bank. GST clearing, now when we purchase something that's going to reduce our GST liability, so it's going to be on the debit side. Cross-reference bank, okay, debit 2,600. Okay, have a go at the practice question, exercise 11.6 in your Cambridge textbook. Okay, page 257. Again, we will walk through you the solution for this in class. Alright, so far we've learned about how to calculate depreciation expense for a year or longer. What if you need to depreciation a non-current asset for less than a year? All right, so if by the end of the reporting period the business has had control of the asset for less than a year, okay, now the depreciation expense will need to be applied on a pro rata basis. So for example, on the 31st March 2015, Ferguson Plants paid $21,000 plus 2,100 GST for a new vehicle. It has an estimated useful life of 8 years, okay, at which point it will be disposed of for 1,800. So that's going to be our residual value. Balance day is 30th June 2015. Okay, so first step is to calculate what's the annual depreciation. So we just apply the depreciation expense formula, okay, using the historical cost minus residual value divided by useful life, number of years, to get our depreciation expense per annum. So historical cost in this case is 21,000 minus 1,800, our residual value, okay, divided by 8. Okay, useful life is estimated to be 8 years. Okay, so the depreciation expense is 2,400 per annum. Now, we haven't finished yet. The second step, we need to apply depreciation on a pro rata basis because we're holding this asset for less than a year. So from 31st March 2015, when we first bought the asset, until the balance day 30th June 2015, how many months has passed? April, May, June. Okay, 3 months passed. Okay, the business has had control of this asset for less than a year. So to work out the depreciation expense for the period ending 30th June 2015, we need to use the per annum depreciation 2,400 times by 3 on 12. So in other words, divided by 12 to get the monthly depreciation and then times by 3 months. Okay, that's $600. Okay, have a go at 11.7. This exercise question specifically looks at how you calculate depreciation less than 12 months. All right, we're almost there towards the end of this topic. I just want to talk about what's the relationship between depreciation and qualitative characteristics. This is very important in terms of answering theory questions. Now, Okay, in calculating depreciation, we make various estimates. Okay, for example, residual value. All right, that's an estimate because we don't know for sure how much the asset is worth, but instead we estimate its residual value. And useful life, how long this asset, non-current asset, will be useful. The number of years, again, it's going to be an estimate. So as these are estimates, using them in calculation of depreciation means that the depreciation expense figure is going to be an estimate as well. All right, and using estimates in this calculation undermines the qualitative characteristic of reliability of accounting reports, because reliability emphasizes that accounting reports need to be free from bias. Okay, so why do we calculate depreciation even though that it violates reliability? Okay, however, relevance requires that all useful information for decision making be included in accounting reports. Therefore, it's necessary to include depreciation even though we are using estimates. Including depreciation expense in the income statement ensures that important information relating to the consumption of non-current assets, in other words, okay, depreciation expense, okay, we are including that in the current reporting period. Alright, similarly, including accumulated depreciation in balance sheet ensures that assets are shown at their carrying value, okay, which is a more updated figure compared to historical cost. So therefore, to sum up, even though the use of estimates in calculating depreciation will undermine reliability, not accounting for any depreciation at all would be more incorrect than accounting for depreciation using estimates. So we are saying that relevance overrides reliability, okay, so that we are making sure accounting reports fulfill the function of providing useful financial information. Okay, so the key here is to say that not accounting for any depreciation is worse than accounting for depreciation using some kind of estimates. All right, okay, homework for this topic. I need you to complete these exercises, all right, at the end of the chapter. Okay, this is the page reference. I also need you to complete all the review questions in chapter 11, okay, for practice on theory questions. Okay, and that's the end.